How to invest during high interest rates. A quick guide: high interest rates can present a challenging environment for investors, as borrowing costs rise and economic growth may slow. However, with the right strategy, you can still find opportunities to grow your wealth. Here's a 5-minute guide on how to navigate investing during periods of high interest rates. 1. Focus on bonds and fixed income investments. During periods of high interest rates, bonds and other fixed income investments become more attractive. As interest rates rise, new bonds offer higher yields, providing a more stable income stream compared to other assets. Here's what to consider: short-term bonds. Opt for short-term bonds or bond funds, as they are less sensitive to interest rate fluctuations. This can reduce your exposure to potential declines in bond prices if rates continue to rise. Corporate bonds. Look for high-quality corporate bonds, which typically offer better yields than government bonds without taking on too much additional risk. 2. Consider dividend-paying stocks. Stocks of companies that pay strong, consistent dividends can be a good investment during high interest rates. These companies often have solid cash flows and can provide regular income to investors, helping to offset any potential volatility in the stock market. Utility stocks. Utilities are often seen as safe bets during high interest rates because they provide essential services and typically offer high dividends. Consumer staples. Companies in the consumer staples sector, like those producing food, beverages, and household products, tend to be more resilient during economic slowdowns and may offer reliable dividends. 3. Evaluate real estate investment trusts, REITs. Real estate can be impacted by rising interest rates due to higher borrowing costs. However, certain real estate investment trusts, REITs, can still perform well, especially those with strong, diversified portfolios and properties in high-demand areas. 1. Focus on quality REITs. Look for REITs that have low debt levels and properties with long-term leases, which can provide stable income even in a high interest rate environment. 4. Keep an eye on inflation-protected securities. When interest rates are high, inflation often becomes a concern. To protect your portfolio, consider investing in Treasury inflation-protected securities, TIPS. TIPS are government bonds that adjust their principal value with inflation, helping to preserve your purchasing power. 5. Diversify your portfolio. Diversification is always key, but it's especially important during periods of economic uncertainty brought on by high interest rates. Spread your investments across different asset classes, sectors, and geographies to mitigate risk. 1. Global diversification. Consider adding international stocks or bonds to your portfolio. 1. Some global markets may react differently to high interest rates, providing opportunities for growth. 6. Hold some cash. Holding cash or cash equivalents like money market funds can provide flexibility. In a high interest rate environment, cash can earn more interest, and having liquid assets on hand allows you to quickly take advantage of investment opportunities as they arise. Conclusion: investing during high interest rates requires a balanced approach that emphasizes income-generating assets, diversification, and caution. By focusing on bonds, dividend-paying stocks, and other strategies mentioned above, you can navigate this challenging environment while still working towards your financial goals. Remember to regularly review and adjust your portfolio as economic conditions change.